forecast for the economy and the appropriate policy that goes along with that. And from that, you can get a clear sense of how we expect to conduct policy if the economy evolves in line with our forecast.
I'm not convinced that is clear because others in the market don't believe that's clear. Other economists don't believe that is clear. And we're not trying to handcuff you, but we are asking that you write a rule within descriptive parameters to use as a reference point. Purely use it as a reference point. And I know one of the things that you've expressed here is, well, we could find ourselves, if we had a rule, we may find ourselves in negative interest rates. Well, simply solve that by writing a rule that says once we do that, we're going to go to 0 and no lower, or maybe 0.25, as you have indicated. We won't call it the Taylor rule, we'll call it the Yellen rule. We can have some of those things that are going to give some predictability, and I think whether it's Douglas Holtz-Aiken or others that have been within the Federal Bank Reserve have said that predictability and that transparency is the way to go. So I know you know that we have a good discussion draft floating around that has some of that information in there, and so just so I'm clear, you don't believe that there is a time that will be right to again go towards a rule-based policy?
I think we need a systematic policy, but I would strongly resist agreeing to follow any rule where the stance of monetary policy depends on only the current readings of two economic variables, which is what your reference rule relies on.
That's what the reference rule does, but it doesn't say that's the rule you have to follow. And we've got a lot of confusion out there. The IMF is saying you shouldn't be raising interest rates. The Bank for International Settlements, which is the central bank of central banks, as you well know, Claudio Borio had said lower rates beget lower rates. And we've got a lot of confusion out there as to the direction we're going, and that's what we're asking for is clarity. Thank you, Mr. Chairman.
I strongly believe in a systematic policy.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of the Monetary Policy and Trade Subcommittee.
Thank you so much, Madam Chair, and my colleague, the chair of the Monetary Policy and Trade Subcommittee, has been discussing with you the Taylor rule, and so I'd like to pursue that a little bit more. The IMF is warning that if Greece leaves the Eurozone, that it might slow growth internationally and impact the U.S. Much harder than expected. I guess I'd like you to just sort of speculate about how, if you were handcuffed, to borrow the terms used here earlier, the Taylor rule, how would that impede your response to such a crisis?
The Taylor rule would tell us that the current setting of monetary policy should depend on only two variables, the current level of real GDP or the output gap and the current level of inflation. So it obviously wouldn't take into account in any way our judgments about likely growth in the global economy, how we expected that the European economy would be affected or global financial markets by such developments. So in that sense, it really restricts, any simple rule restricts the setting of monetary policy to a very short list of variables, and typically their current values. That's one of the reasons. I mean, we spend a great deal of time, and the forecast that we include in our monetary policy report that the participants write down, we present to the public every 3 months, incorporate all of the kind of information, what we think is going to happen in the global economy and other economic developments. Those factor into our economic forecasts and our view as to the appropriate role of policy. We are providing a great deal of information to the public by providing these participants' forecasts, because participants are telling the public how, in light of their economic forecast, concretely with numbers, they think monetary policy should be set. So that is information about the so-called reaction function, namely the relationship between the economy and monetary policy, that is incorporated in something like the Taylor Rule.
Thank you so much. Can you provide us with a quick update of the Fed's implementation of the so-called Collins fix governing insurance capital standards?
Well, we appreciate Congress's passing the Collins fix, and in light of that, we have a great deal of flexibility now to design capital standards that we think will be appropriate for the firms that we supervise, including the insurance-based savings and loan holding companies and the insurance SIFIs. And we're working hard. We will put in the public domain either orders or a proposed rule when we've figured that out.
Thank you so much. We're the 5-year look back of Dodd-Frank. Our colleagues again say that we've enshrined too big to fail. Wonder if you could just set the record straight about whether or not Dodd-Frank enshrined too big to fail.
Well, I don't believe that Dodd-Frank enshrined too big to fail. First of all, it directed us to increase the safety and soundness of financial institutions, and particularly those that are most systemic. So it gave us tools to raise capital and liquidity, to impose capital surcharges on those firms that we deem most systemic, to use stress testing as a methodology to make these firms much less likely to fail. And the amount of capital and liquidity has increased massively since the crisis. In addition, Dodd-Frank gave us both Title II orderly liquidation authority, which would be a new tool to resolve a systemic
I got 10 seconds
firm,
left, so
and Title
I think you've just covered it. Back to my idea about the labor market. Do you think ending the sequester and raising the minimum wage would be good strategies for getting our labor markets together?
Well, this is, I think, matters for Congress to debate.
I knew you'd say that, so I
The
saved
time
it
of the
last.
gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of the Capital Markets Subcommittee.
Good morning, and over here, thanks. Thanks, Chair. So in front of me, last night I read through what is called the Joint Staff Report, the U.S. Treasury Market on